Hello again, and welcome to A Few Minutes with Marcia. My name is Marcia Clark. I'm the Senior Research Analyst at Warren Street Wealth Advisors, and today we are going to take a stab at reading the economic tea leaves, at trying to figure out, is a recession coming or not? So as always, I've drawn this data from sources I think are reliable, but please don't take this as investment advice for any entity or institution. Now let's start by putting a broad framework around this discussion. There are positive factors and negative factors facing us. If we look at them side by side on this helpful chart, which was produced by Wells Fargo Investment Institute, you can see on the positive side are tailwinds. We have accommodative central banks. The banks are ready to help us if the economy slows down. Low interest rates. We do have positive corporate earnings, households are in good shape, and we even have China on board now, trying to keep the economies going. On the negative side, on the headwinds, we have these continuing trade disputes and tariffs. There are geopolitical risks out there. We don't know what's happening with Brexit, even still. We don't know what's going to happen even with our own election coming up in 2020. There's these populist trends, this idea of me first, not in my backyard, anti-immigrant, which are causing some slowdown in these international economies. And overall, the businesses are just not sure whether they should invest right now or not. So pros and cons to the global outlook. Wells Fargo thinks overall we're okay. They put together again this nice summary. GDP is growing, even though slowly it's growing. Wages are going up, which is positive. Market volatility is also going up, even though we've had some big zigs and zag in the past. It is going up from a fairly low rate. Consumer confidence has been falling, but it's been falling from a fairly high rate. Unemployment is near record lows and inflation is under control. So on balance, Wells Fargo would say we're doing okay. But the point of today's Minute with Marcia is for you and I to come to our own conclusion about whether the economy is stable or if we should begin to plan for a slowdown, for a recession. So it's an 11-year expansion. It has to end at some point. Is it going to be now? And that's the question that we want to ask ourselves or try to answer. Well, let's start with the basics, GDP. GDP is a measure of economic activity in a country, and it's made up of household spending, government activity, business activity, and trade. And we're going to start today with business activity. But first, the most recent GDP print we got was 2%. Now 2% is not exciting, but it is just about at the average since the Great Recession of 2008 and 2009. It is lower than these nice high bars that we saw in 2018 and 17, but some of that growth in those months probably came from one-time sources such as tax cuts, which we're going to talk about a little bit later. Looking at corporate earnings, we've heard that these earnings are slowing, and that's a worry. But actually, relative to this long-term average, corporate earnings are pretty good. And if you do think about these high points coming maybe from these one-time stimulus from tax cuts, and you normalize those, we're actually still on a pretty solid positive trend. So yes, earnings are slowing, but they're slowing from a pretty high pace in 2018 and probably aren't slowing enough to worry about, at least not yet. Where we really do see business struggling is the manufacturing sector. You've heard it again and again in the news that manufacturing is in contraction territory overseas and just barely above in the expansion area in the United States. Yeah, the trade tariffs are not helping a sector of our economy that's been slowing for years, frankly. But at least we can say since 2018, industrial production was at 106 and manufacturing was at 104. By September, we're at 109 and 105. So even manufacturing is growing. It's just not growing much. There's not a lot to be done about that, unfortunately. Corporate debt is another area that we hear about. There's record levels of corporate debt, and that is definitely something to worry about. Let's think through a little bit. Let's peel back the onion on why they're taking on so much debt. Well, right now, interest rates are really low. And if a corporation has ongoing business needs, they'd like to fund them the cheapest way they can. So why not take out a bond that for a 4% or 5% coupon or even less? Some of them are getting interest rates as low as 3%. So there's a reason for corporations to take on that debt when rates are low like this, and the debt burden, at least the interest payment burden, is not bad at the moment. So something to watch, but if we understand a little bit more about why they're doing it, maybe we don't have to worry quite as much as we otherwise would. Household debt, on the other hand, is looking terrific. We have this net worth chart on the left-hand side here. This big purple area is the value of financial assets that households have. This is the value of real estate assets. Down here are liabilities, and this little dot is net worth. Net worth of households is positive. We have more assets than liabilities, and that's great, especially after that huge slump in the recession, 2008, 2009. It took a lot of years for households to dig their way out of that. But right now, thanks to low mortgage rates, household debt service is very low, net worth is very high, households are looking good. One reason for that? Jobs. People have jobs. This is the number of people with jobs at a high, the rate is at a low, the percent of population has been gradually trending up. It has some bumps along the way, but gradually trending up. And there's more jobs available than they are able to hire people. So as long as the labor market remains strong and housing or households are not filled with debt, we actually could go on for indefinitely. But we do want to take another look at one of the mixed sectors in the economy, which is housing. It's not been doing great in 2019. They have some good months and some bad months, but overall not terrific. So let's take a look at housing because it has a big impact on the rest of the economy. Well, one constant is that people want houses. Demand for housing is really strong, even when supply has not been able to keep up. The number of months it takes to fulfill people's demand is just, as I say, not keeping up. Affordability is a problem. Our affordability is getting worse as housing prices are rising, but thankfully with mortgage interest rates pretty low, the mortgage payment burden isn't so bad, similar as the corporate story we told you before. And builders have been on a positive trend. Now we took a dive here at the end of 2018, but mostly the trend is going back to being positive lately in 2019. So the key here, I think, is that if interest rates remain low, which is what most people expect, then builders will probably build and people will buy. We have housing starts up now more than 8% since the end of 2018. So there are signs that the housing sector is going to be okay. So what? We've got some pressures out there, some tensions out there, mostly from international activity. And then we've got some slowing in the manufacturing, corporate earnings. So, there are reasons for concern. On balance, though, people have jobs. Wages are going up. People are building houses. As long as people are spending money, the economy will be positive. So I'm saying recession is not around the corner. It's kind of steady as she goes. You may not want to take it from me. There is a conference board which does their leading economic indicators, and they've come up with their most recent outlook in October, which says they expect the decline in industrial production to ease, and consumers and labor markets to remain strong. So the economy, if you look at all the data and weigh it all out, actually is okay. So when you're making your own decisions for your household spending or your business spending, it's prudent to go ahead and think on the positive side of this equation. The glass is half full instead of half empty. Yes, we are slower than we'd like to be. Here's America here at the top of this global chart. But we're faster than Europe and the UK and Japan. These more developing economies are doing better than us. And overall, the world is still growing. Even with the tensions and the uncertainty, the world is still growing. So my recommendation is to make prudent investment decisions for yourself, prudent financial decisions for yourself. that are productive, that are likely to be useful for this 12 months, 18 months, however long. Expansions don't go on forever. A recession will come sooner or later, but I don't think it's around the corner. So this has been a few minutes with Marcia. I hope that you found it helpful. If you have any questions, we hope that you'll reach out and talk to us. Talk to you soon.